Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Calibre Mining. Calibre is traded on the TSX under the ticker CXB and on the OTCQX under the ticker CXBMF. And we're joined today with the Senior Vice President of Corporate Development and Investor Relations at Calibre Mining, Ryan King. And Ryan, great to get you back on the show. It's been a couple months, man, since we've had you on, and you got a really dense news release that I want to dig into from November the 5th. And we'll put a link to the news section down below so people can follow along. But you really get into not just the financials from the third quarter and year-to-date numbers and operations, but you dig into the Valentine Gold Mine construction process and then even a larger expanded exploration program. We'll get into all of that, but let's start off with the operations and I guess the key takeaways from Q3 and year-to-date numbers from Nicaragua and Nevada.
Well, hi, Shad. Good to see you again. Good to be back on the report. I appreciate the interest. And, it's been a busy time, as always. But importantly, as you rightly pointed out, Q3 was a challenging quarter for Calibre. We put out an announcement on October the 18th, which actually included the quarter's production of 46,000 ounces, below expectations, which resulted in higher per unit costs. So higher per ounce production costs and all-in sustaining costs. Yeah, that went out October the 18th. We actually hosted a conference call that day to get in front of it and address the quarter and what happened. And at the same time, we also put out an update on the Valentine Gold Mine that we're building in Newfoundland, Canada. And of course, the update resulted in about a $70 million Canadian increase to the initial capital cost of the project. And we talked a little bit about that on the conference call, and I'll get into that. But first, let's start with production. 46,000 ounces was below expectation for Q3 and resulted in a revision of our guidance. Revised guidance up in terms of total cash costs and all-in sustaining costs, and revised production down. So for the full year 2024, it's about 18% reduction in ounces and about 18 equally so to the increased in costs. So about 230 to 240,000 ounces of production for the year and an all-in sustaining cost range of 1,550 to 1,600, 1,300 to 1,350 for total cash costs. And let's talk about that just for a moment. It is worth addressing this because going into Q3, our total spend, we talk a little bit about total spend and how that compares to our 2024 budget going into the year. Going into Q3, our total spend was on budget. So meaning all of the monies that we are spending for the project, for operations, for exploration were as per our original budget. As we went through Q3 and we finished Q3, we actually ended up favorable on a total spend basis. I think we were probably 3-4% favorable against our budget of total spend for 2024. However, when you look at this on the face of it, you would anticipate that we're spending a lot more money because of the per unit costs, but we're not. It actually is all related to the lower ounce outcome result in Q3. So a significant decrease in ounces led to the dollar per ounce increase on a total cash cost and an all-in sustaining cost for the quarter. So it's not because of inflation. It's not because of any technical issues. This is just largely due to what happened during the quarter. So now let's get to what happened during the quarter. We did address this on October 18th, but just for the benefit of those listening on this podcast is twofold. And this was all related to our operations in Nicaragua. Firstly, we had been starting to bring on a new open pit. So as you know, we operate a hub and spoke model in Nicaragua. So a hub, the Limon Mill or the Libertad Mill is a hub that the total capacity is 2.7 million tons of processing capacity. And then we've got several quote unquote spokes. So these are satellite mines, open pit or underground, that we have permitted over the last 4 or 5 years since becoming an operator there. And we mine there and we haul that material into one of the hubs. And we were bringing on a new one in Q3. What happened there was more artisanal or small mining activity in the very early part of the open pit than we anticipated. We made a mistake. We underestimated the amount of small mining activity. It's really important for the audience to know that these are non-mechanized, non-industrial, small miner activity. So it's no mechanical equipment. And generally what happens, it happens all around the country, and it's actually legislated that any small miner can work on 1% of any mineral concession within the country. And companies work with them all the time. We've worked with small miners across all of our different assets in the portfolio. We have no small mining activity on any one of our current mining operations, but they are around the country in a pretty significant way. It's part of the culture within Nicaragua. So there was historical, and there is no small mining activity on this open pit. This is what is known as the Volcan open pit, and we've talked about that in press releases. But the initial bench here, the initial bench for 2 of the Volcan open pit had more activity than we thought. So it ends up being an underestimation and a total loss of approximately 20,000 ounces for the year for Calibre. We're through it now. So we've gone through that loss. We're now reconciling grade and ore per our model. And so we're back to normal on the Volcan open pit source going into the Libertad mill. That was one of the issues we had during Q3. The second issue, and we put a press release out in June that talked about a wall movement at one of our Limon open pits. So we had a wall movement, which resulted in us not mining in that area for several weeks, assessing all the details. There was no damage to this. It required a remediation plan. We started to put a remediation plan in place, and there's been a number of changes as a result of this remediation plan because we didn't get through the whole remediation plan and get to what we call the face positions. Face positions, or the higher grade ore that was expected to be coming in Q3, which is now resulting in it coming in Q4 and into 2025. So it's a delay of delivering high-grade ore to the mills. We did manage, obviously, to hit some lower-grade areas, and we've been remediating that through Q3. We just didn't get to the high-grade source. So a delay of ounces in Q3. And, of course, when you don't have a denominator that is a number that you would expect, but your total spend stays the same, right, you're going to anticipate having a per-unit cost go higher. And that's what happened with our total cash cost, all-in sustaining cost in the period. All of that being said, we've identified the issues. We've brought in, and we were working on this for quite a while, but we brought in a new chief operating officer that Darren Hall has worked with at Newmont. So he's got a tremendous track record and experience operating all around the world. His name is David Schumer. So he's joined us, and he's spending all of his time down in Nicaragua now, ensuring that we deliver on expectations for Q4, which in fact we've put out in November when we had our earnings release, and in October, which we stated would be about 60 to 70,000 ounces in Nicaragua, and a total consolidated ounce outcome of 70 to 80,000 ounces for Q4. Again, that was due to the delay in ounces, but at the same time, we're also increasing our haulage capacity from Limon to Libertad. We've increased it 30%. But even though we've increased it as much as we have for the quarter, we're not able to process all the mined material. Henceforth, we'll have about a 30,000 ounce, 20 to 30,000 ounce stockpile build that'll lead us into 2025, and we'll start to get bled through the operations Q1, Q2 of next year. So yeah, a challenging quarter, Shad, which resulted in the revised guidance. I think some of this, obviously, a total loss of 20,000 ounces at Volcan, that is a mistake by Calibre. I mean, both were mistakes by Calibre, but one is a delay of ounces versus a loss. So if you were to step back and say, okay, if you did all of these things and you had that 20,000 ounce loss, you're only, I think we'd be sitting around 265 to 270,000 ounces or close to that if we were to be able to process this 30,000 stockpile in Q4, and we delivered what is expected of us in Q4. So We've been growing very fast year over year. We've been adding these satellite deposits into our plans. We've been delivering on that responsibly year over year, and this is the first time in 20 quarters that Calibre missed a step. And I think, it's fair to say that, right now from an institutional perspective, as well as retail and all investors for that matter, people are wondering, oh my gosh, is this something that is going to be going on into the future? And I'm fairly confident that it won't, given the bench strength we've added, the focus, the team. But yeah, no, unfortunate for the quarter from a production perspective and a delivery perspective. We've lost some confidence. We've got to regain that back.
Well, Ryan, I really appreciate the candid breakdown of Q3 moving into Q4, that there was, some lost ounces, some deferred ounces, and then it looks like the stockpile is going to be rolling into Q1 of next year. I was set to ask you some really tough questions, man, but you already fell on the sword for it. And I think it's a great thing just to come out and talk about what happened to the marketplace so everybody understands it clearly, and that these are not chronic, ongoing things, but just like you say, a misstep from Calibre after years of nailing it over and over again. And so many conversations we've had over the years. I guess let me take the other side of this. I was going to ask you some tough questions, but you've kind of painted a picture that I think people could focus on the negatives, but let's also focus on even your year-to-date AISC, your all-in sustaining cost at 1656, and that's between Nicaragua and Nevada. Gold's at 2600, so you're still making fat margins. You're still making money. Would you like to say anything about the fact that while this didn't go as planned as a company, you're still producing a lot of cash and you're holding a lot of cash on the balance sheet? Could you maybe talk about the financial strength of the company?
Oh, sure. Yeah, no, I mean, you bring up a valid point. We've had a very good, I mean, all of us gold producers have had a good run this year because of the price of gold predominantly, right? We step back and we look. I mean, a couple of weeks ago, I think gold was north of up 30% year to date. I think we're sitting somewhere around 26, 27% year to date physical gold price performance. So for any sort of business that is in the discovery, development, or production of gold, it's been a great place to be because we all have had great cash flows as a result of that. Now, I think the expectation amongst all of the market, myself included, would be really focused on margin expansion. So, unfortunately, due to these, our Q3 and the higher cost base, we haven't seen as much margin expansion. But I believe, and you said it, that this was a one-off type of a situation, and we'll start to see more margin expansion. I'm very hopeful for Q4. I mean, the gold price has come off approximately $200, $250 in the last 2 weeks or so. But I think it's worthwhile to note that we're at 25.50, 25.80 in that range of gold price. So this is a tremendous price for producers. And as you said, 1,600 and change all-in sustaining costs year to date. And here we are at 2,500. And I think that's probably, I think that for the full year to date, average is somewhere around 23, 2,400. So there's excellent margin there. And upon delivering a strong Q4, we're going to have a fantastic Q4. But the company is in good financial position. As we'll get into, we're building a major, well, it's Atlantic Canada's largest open pit gold mine in Newfoundland, Canada. So a lot of our cash flow is going back into our business to make it more robust, more diversified from a jurisdictional and mine perspective. So at the end of Q3 here, we had 115 million US in cash. We have, of course, with the acquisition of Marathon Gold closing in January of this year, we inherited their assets and liabilities. And one of those was the Sprott Resource Lending loan package for the initial capital of the Valentine Gold Mine in Newfoundland. We had $100 million of Sprott Resource facility available to us remaining on the project. So that puts us about 215 million, about 300 million Canadian, right, when we convert it to Canadian dollars. And at the end of Q3, after the updates we put out, we had about $197 million remaining for the initial project capital to first gold in Q2 of next year. So in a great position with these gold prices, we're generating good cash. In Q4, we're going to have a strong quarter, but we're also heavily investing in exploration. So we're not taking our foot off the gas, and nor are we expecting that gold prices will sustain a $2,500 to $3,000 ounce gold price environment. it's a luxury for us to have these kind of gold prices and a luxury for our stakeholders and shareholders. Do we run our business expecting that? Absolutely not. We run at a much lower, more conservative gold price assumption so that we can ensure that, during the ups and the downs, we can manage our business appropriately so that we don't run into any financial burdens or issues. So, no, I'm very excited about the way things are from a financial perspective. We're funded through first gold at the Valentine Gold Mine, and I think next year it's going to be an exciting year as we bring on Valentine and continue to operate Nicaragua, Nevada, and work towards a 400 to 500,000 ounce a year business. That really, when you look at it and going through this build, we don't have a huge amount of debt on the balance sheet. Just the Sprott Resource facility. So I believe that we'll be in a position to pay that down relatively expediently, and if not, look at options to refinance that at the end of 2025.
All right. Well, I appreciate you breaking down the financial picture for Calibre, and it sounds pretty strong. Let's get into the build then. The Valentine Gold Mine, as of that press release, was at 81% construction. You just covered the capital cost that's left to build it at 197 million Canadian. That you got plenty of cash on hand and that credit facility to be able to handle that. Now, I think people will want to know what is happening on the ground. What kind of activities are still left to do as you ramp up into gold production, I believe, in the first half of next year by Q2 of 2025. What else has to happen? What has been happening? What's the final, timeline to production?
Sure. I'm about to update our corporate presentation on our website. We're about to do some institutional marketing here over the next few weeks. And I think it's worth it to go to our website and take a look at some of these photos we've been uploading, showing the progression, showing the changes. It's pretty significant. I was there the first week of September. We brought a number of analysts that cover Calibre to show them the progression, to show them where we're at, how things are going. And I think everyone was very pleased and impressed with not only the progress, but the team that we have assembled there to operate this plant. So we're already well advanced in terms of getting ourselves set up for a Q2 first gold and then ramping up to commercial production. So we're in a very good position. Most of the senior leadership team, if not all of the senior leadership team, in place to deliver this operation. And this is an owner-operated mine, so we don't rely on mining contractors for this. We're solely 100% employee based and making very good progress. That's a question we get a lot, Shad, is how is it going to employ the people that will be operating there? And there's a significant level of interest to work in Newfoundland. There's a significant level of interest to work at this mine. And I think we've attracted some very high quality talent. Jason Sear as our VP operations, and a number of other folks there that have had experience all across Canada operating mines, very strong in the technical services department, from a mine planning perspective, the maintenance department, the metallurgy department, the mill management. So we've got some very good people there. That's critical when you look at bringing these mines on, these larger operations on. Not only do they have experience, but they want to be there, they're passionate about what they do, and we've got a great team in place. I think we're sitting at about, as at the end of September, we were about 81%, so you can imagine that we've made some progress since then. We would anticipate to be mechanically and electrically complete on the mill and site by the kind of early Q1 timeframe. And then you go through various levels of commissioning. And we've already brought in the commissioning team. We've hired a group called Reliable Controls Corporation out of Salt Lake City and led by a gentleman by the name of Tim McKay. This is a group and an individual that Darren has worked with in the past. When Darren was at Newmont overseeing Boddington, he brought Tim in to work with him on that operation, and it was quite successful. So we brought that group in early to look at all of the policies, procedures, and go through the mill. And starting, they've actually just mobilized on site there. And so going through that whole process now. But there's also going to be a couple of photos on the website that show mining activity. We're of course mining the Marathon pit, the Leprechaun pit. A lot of waste rock is going into foundations, footings, roads, etc. across the the property. And of course, we're building a stockpile for first ore going into this mill in Q2. So in a really, really strong position, I think, from all aspects of the build, but importantly, all aspects of first gold in Q2 and having the team to deliver it.
Well, let's also talk about the exploration program at the Valentine Gold Mine and around that area. You've had an ongoing 60,000 meter program in place at the Leprechaun and Marathon deposits, but you've just bumped that up and added another 100,000 meters that will go from this year into next year. But that's 160,000 meters of drilling at the Valentine Gold Mine. That is a large exploration program. Maybe give us a little color around some of the key targets or some of the things the team is sussing out with this large program.
Sure. No, I mean, look, I like the fact that we have this really underexplored district. I mean, that really is the value opportunity for investors, whether it be an exploration stage, early stage exploration stage company, a developer that is investing in exploration, or a company like our size that can fortunately self-fund all exploration to try to find more whatever commodity you're looking for, right? This is really, when we get down to it, the value proposition that companies like ourselves can bring. I mean, let me ask you, Shad, if a company, an exploration company, has an amazing drill hole, does the share price go up or does it go down?
Well, in theory, it goes up, but this market has been tough.
Right, but somebody discovers something new, 9 times out of 10, it's going to have a tremendously positive impact on the share price. And this is it. This is what we're all looking for. It's to add resources, to add reserves, to discover new deposits within our portfolios. And, it might not have as much of a dramatic impact immediately for a company of Calibre size with a $1.3 billion valuation, but it tremendously adds. So if you discover new or expand resources, it tremendously adds to that net asset value base. And that's why we do what we do. We continuously invest, and we've seen the benefits of doing this in Central America. I mean, we've produced over 850,000 ounces of gold since Q4 of 2019. We've gone from a 250,000 ounce reserve base to a 1.15 million ounce reserve base. We've discovered new deposits across the portfolio whilst self-funding that exploration. And I'll be honest with you, Shad, like we've had some good success. We've had some great success there, but we haven't had all of a sudden this, oh my goodness, we found a multi-million ounce deposit. And I think we're getting closer and closer to that event. But here in Newfoundland, you've got 5 million ounces in resources in all categories. You have a situation where you've had a previous development exploration company with limited funds that discovered Leprechaun in 2011. They discovered Marathon, the Marathon pit in 2015. And the reason these were discovered was because this particular host rock outcropped on surface. And so the geologist went there and said, this looks very interesting. They started doing some samples. They drilled, they discovered because of the outcropping. The Berry pit lies in between those two deposits, and we've got some pretty good graphics on our presentation or on our website. It lies in between Leprechaun and Marathon. And there's typically in this type of part of the world, you get various marshes or bogs, and Berry ends up being underneath a bog, so it did not outcrop. And it was discovered through what we call condemnation drilling, is where company goes out and they're siting where they're going to put various infrastructure on their property or mills or whatever. And they discovered the Berry pit. There has not been really a focus on regional exploration along this prolific, what is in our view, a prolific with 5 million ounces, very likely hopefully in my lifetime, going 5 to 10 to 15 million ounces because of under exploration. We are seeing a very systematic periodicity to these deposits. We're seeing the host rock, quartz tourmaline pyrite, across the whole property, not only on the Valentine Shear major fault, but on the corresponding fault that's been now mapped out on the other side of the property called the Northwest Contact, another fault over there that has had zero exploration. So the 60,000 meter drill program, there was a bit of diamond resource expansion discovery drilling in that, but most of that was focused on RC infill drilling. So within the Marathon pit, we've been doing what we call infill or grade control drilling. So this is every 9 meters, 9 by 9, we do another hole that goes down 20, 30 meters to basically get grade that will go into the mill. But then we've put out a couple of releases comparing the grade or comparing what we're finding to the 2022 reserve model. And so far in the first few benches, albeit it's only been in the first few benches of the open pit, but it's been correlating better than expected. So particularly when you look at Marathon's pit so far, we've seen 47% higher gold grades in the initial benches from this ore control drilling, which has resulted in about 44% more ounces in this area versus the 2022 reserve model. At Leprechaun, we actually ended up discovering quite a bit more tonnage of reserves. So, which led us to the initial drill program on the very edge of Leprechaun, where we discovered some additional mineralization. This is where I think it gets really exciting because, again, the folks at Marathon did a great job, but they only had limited funds and they had to advance what they had to get it into feasibility, to get those reserves. So you had to do a lot of infill drilling. Well, on the edge of Leprechaun, this gets us quite excited because from the edge of Leprechaun all the way down to what we call the Frank Zone, it's about a kilometer. And it's a marshy bog area that the Marathon folks did no drilling on. We did a little bit of drilling on the edge of the Leprechaun pit. We hit 2.3 grams over 15 meters. We hit some high grade hits in there as well, right on the edge of the pit, telling us that there's something going on further to the south towards this additional Frank zone that doesn't have any resource on it either. And we had some success over at this Frank zone as well, again, a kilometer away, hitting about 3 grams over 15 meters. We've hit a couple of high grade hits, 40 grams over 2. And there's a number of holes in there, but it's, when you look at it, it's just tremendous that there's been no exploration. So we will be getting in there and doing some exploration. We haven't done too much there. We've been doing some drilling at Frank and a few other areas north of Marathon, staying fairly close to the known resources, but targeting some areas that the exploration team says, well, this hasn't been drilled or that hasn't been drilled close by. But the 60,000 was really based on that infill, as well as a very small amount of diamond. Ever since July, and we mobilized the rigs in August, we started to drill a bunch of other targets. And it took 15 years to discover 5 million ounces. We obviously have a much better roadmap now. We have a better understanding of the geology and the architectural situation there. So, we're very hopeful that we'll find ounces quicker. But it takes a lot of work to add ounces. It takes a lot of scientific work to be successful there. We've brought in structural geologists and we've been able to put some real work and muscle into the science behind finding the next 1 to 2 million ounce deposit here. So I think we're on the right track. I would anticipate we'll have some Newfoundland results out to the market here, definitely before the end of the year, if not in the next sort of 2 to 4 weeks here, I would expect. Same with Nicaragua. I mean, we've been drilling there quite extensively. We've had some results out in September, in August. Well, we should have another batch out here before the end of the year, where we've had between 10 and 13 rigs active all year. And we have been consistently putting out results. So, very exciting across the portfolio, all of the exploration upside. And, I take a step back and I say, well, Calibre, for our shareholders, for ourselves, for all involved, we're an exploration company first. And luckily, we're self-funding that exploration to find new deposits, expand resources, not only for sustainability, but with a focus on creating value and making that share price performance be better than just buying a bar of gold or even versus our peers. So that's our focus.
Well, Ryan, I think we'll wrap it up there. That's a nice summary of kind of the exploration forward focus of the company, self-funding it through organic growth and production. And so we're going to keep following along with all the aspects, the operation, the development, and the exploration at Calibre Mining. And maybe we'll get you back on by the end of the year again and just do a deep dive into some more of this exploration work, both in Nicaragua and in Newfoundland. And for those following along with this interview, if you want to follow along with the news at Calibre, click on the link below this and you'll go straight to their company website, right to the news section. You can sign up for email updates on the news. And Ryan, keep us posted as some of those drill results come out from either program. We'll get you back on maybe by the end of the year and just do another solid deep dive into all the exploration, all the drilling Calibre's doing. And as always, looking forward to our next conversation.
Thanks, Shad. Appreciate the time. Look forward to it.